Welcome, friends. Let us again have a quick look at some aspects related to the insurance documents. And this is based on the guided documentary credits separate records for CDCS. Insurance documents. For example, if the credit calls for an in quote terms CIF, then the risk on the goods passes on to the buyer when the goods are on board the vessel. And suppose it is CIP. The goods have been delivered to the carrier nominated by the seller at an agreed place. Then, at that point of delivery, the risk passes on. What does it mean? It means the risk passes on to the buyer at a particular point, and the supplier is no more responsible. Which, in other words, the insurance responsibility or liability to insure the goods lies on the buyer thereafter, because the supplier is supposed to have completed his delivery responsibilities. Having said this, when an LC is issued with the FOB as an Incoterm, the issuing bank will ask the applicant to arrange for insurance and give them proof irrespective of the fact that when the shipment is happening. But if CIF or CIP is an Incoterm, the issuing bank will say the beneficiary will have to submit an insurance document or insurance policy under the credit, and so that the nominated bank, the confirming bank, the issuing bank, everybody can check their acceptance and be satisfied that the underlying goods are adequately insured. So, one of the documents called for could be an insurance document. These insurance documents should meet at least the basic marine insurance transit requirements, and it should provide a sufficient and effective cover. Sufficient and effective cover is there should be a minimum risks could be covered. There should be a minimum amount of risk coverage, and it should cover the marine transit insurance, the basics. Some of the clauses could be ICC clauses, institute cargo clauses, warp risk, or straight right civil commotion, or jettisoning and washing on board, or theft, leverage, and non-delivery, depending on what happens. Now, one of the most famous clauses is called the London Underwriters Clause, or the other one is the American Insurance Clause. So, these are the two most famous clauses used in the various insurance policies. The London Underwriters Clause is called 1982 clause. It was effective in 1982, and later it was amended in 1992. The insurance document submitted should have some notation that says that will permit the insured or the holder to make a claim in the event of damage or loss of property. So, the insurance policy, the purpose or the function is it should enable the holder to make a claim in the event of a damage or loss to the cargo. Holder ultimately will be the applicant of the letter of credit. So, it should be endorsed, or the title on the insurance document should be so passed on to the issuing bank or the applicant in the credit. Now, banks will call for insurance document, or many times it will call for insurance policy. If a policy is called for, certificate cannot be submitted, cover note cannot be submitted. If a certificate is called for, policy can be submitted. If a cover note is called for, policy can be submitted. The insurance policy is a jumbo document. Why it is a jumbo document? Because it is as per the Marine Insurance Act 1906, insurance policy is the only document that evidences the terms and conditions of credit and is capable of being assigned by transfer and endorsement. Insurance policy is defined in the Marine Insurance Act 1906 as a policy capable of being assigned by transfer and endorsement and an evidence of terms and conditions of the underlying insurance contract. So that is why banks insist on insurance policy. Insurance certificate is a snapshot or a small short form or a summary of the insurance policy. And cover note is an evidence that insurance has been applied for and insurance policy will be issued. It is not evidence of insurance policy, but evidence of a request for insurance policy. It's an advice that policy will be issued. Who will issue, when it will issue, has it been issued, what are the terms? Nothing will be there in cover note. It will just say very minimum information given by possibly an agent of the insurance company to the party asking for insurance. The applicant will have to avoid the use of imprecise or ambiguous terms. If it is used, the beneficiary will be getting such an insurance policy which may not meet the requirements of the applicant. The insurance should be for 110% of the merchandise value. Not necessarily the invoice value and merchandise value will be the same, because invoice may have some deductions. And also, if there is a transferable credit, the second beneficiary's invoice will be lesser than the first beneficiary's invoice, but insurance should be for 110% of the invoice submitted by the first beneficiary before submission to the issuing bank. So it could be for 120 or 121% also. If the LC indicates 110% invoice, that means that's the minimum requirement. 120 is not a discrepancy. If LC is silent, 110 is the minimum requirement as per UCP. If the LC is silent, the insurance can be presented for 120%, still it won't be a discrepancy. The insurance policy has to state all the risks and what has been covered. Insurance policy has to state all the risk that has been covered. Now, this Institute of London Underwriters Clause, what we saw earlier as a London Underwriter Clause or an Institute Clause, is called the ICC. I for Institute, C for Cargo, C for Clause, ICCA. ICCA is all comprehensive risk cover. It is, if a LC calls for all risk cover, then ICCA could be mentioned. If a LC calls for ICCA, all risk can be mentioned. These are equally synonymous. A is all risk cover, B is still risk restrictive or still lesser items are covered, and C is more confined, progressively more confined compared to A and B. So the minimum requirement under the credit is ICCC, and if the LC mentions something else and ICCA is provided, then ICCA is considered to be an all risk cover. What are the items covered under ICCA is available in the insurance website. At the same time, if the LC calls for all risk, then this clause is enough. If the LC gives a list of risks areas to be covered, then that list should be available in the letter of credit, along with the notation all risk cover, and such a all risk cover notation will be accepted by the banks. There is something called average adjusters. Now, average adjusters, what they do is, in case there is a loss or damage sustained by the ship or the cargo, then the average adjusters come into play. What they do, they look at whether it is a particular average or a specific general average. What is it? The common interest of the ship and the cargo, if it is borne by all interested parties in proportion to such interest, it is called general average. If the loss or damage had happened to the common interest of the ship or cargo, if the loss or damage had happened to the common interest of the ship or cargo, and if it has to be shared by all interested parties in proportion to such interest, it is called the general average. And then this average adjusters will decide how much will be shared by each of these parties, interested parties. The interested parties may be the parties holding insurance for the goods or parties holding insurance for the ship. What's the particular average? Particular average is when the owner or insurer of the lost, damaged or cargo has to bear the full loss. That means if the ship has sunk, the ship owner will have to bear the full loss, and if the cargo is sunk, the cargo owner has to bear the full loss, and it will not be shared between the other insuring parties. Why this is required? This is required because in many cases, when they go in for insurance of the ship, they will insure the ship and they will also insure all the cargo in the ship that the ship is carrying while it is floating on the high seas. So there may be some liability on the party of that insuring company to pay for the cargo loss. So to what extent they will share this? This is one of the situations when this general average and particular average would come into picture. Let us have another example. If there are some large cargoes on deck of the ship, and at some point in time they find the ship is too heavy and they have to offload some cargo and dump into the sea, and they throw away some of your machinery and some of your plant and equipment that is coming on deck of the ship, then you suffered a loss because your goods are gone. But your loss or your goods have been thrown away into the sea to safeguard the ship and to safeguard other cargo, to make it less heavier so that it can float and safely complete its voyage towards the port. And because of that, the loss suffered by you, the insurance company that is paying your claim, will not be paying 100% from their pocket. They will definitely go in for these average adjusters and find out how much the other cargo owners and the ship owner will be willing to share the loss that insurance company is suffering by reimbursing your loss for you using that plant and machinery. So this is another situation where it is coming into play. Let us look at franchise. If the insurance policy says a franchise of 5% is applicable, then the insurance company will not honor any claim below 5%. If it says franchise of 5% is applicable, then losses up to 5% will be paid out of the pocket of the insured person and not the company. Loss of 6% is there, then they will come in and pay, bear that loss, or they will reimburse you the loss incurred. If there is an excess of 5% mentioned in the insurance policy, then 5% will be deducted from the amount of any claim that is being honored. Which means if there is a loss of 6% and the policy says excess is 5%, then 1% will be paid by the insurance company. If the loss of 95%, 90% will be paid by the insurance company. A loss of 100%, 95 will be paid by the insuring company. This is what is an excess of 5%. Whatever loss is there in excess of 5% will be paid by the insuring company. Whatever loss is there up to 5% will be borne by the insured party irrespective of the amount of loss. In case of franchise, if there is any loss up to 5%, insurance company will not pay anything. If there is any loss beyond 5%, insurance company will pay the full thing. Here, insurance company will pay the full value. Here, insurance company will pay an amount which is over and above the 5% excess. Insurance policy may mention franchise or excess, and if an LC calls for a respective percentage, then a franchise or excess should not be mentioned. The words irrespective of percentage need not be there unless LC insists that these words has to be present in the insurance document. Now, the specific notation versus the standard policy terms. Now, standard policy terms will be mentioned in the credit, but if anything extra has to be mentioned, then the credit has to say what has to be mentioned and what risk cover or what other clauses have to be added. Deck shipment is normally allowed, and if deck shipment is not to be allowed for specific goods, the LC has to call for an additional cover called JWOB, jettisoning and washing on board. Jettisoning and washing on board is that throwing away the goods by the ship to say other cargo is called jettisoning, while washing on board is the sea waves washing onto the ship and creating damage to the goods kept on the deck. The LC may call for claims payable at, and it is unnecessary to avoid unnecessary negotiations in foreign jurisdictions. This is the very purpose of calling for that. But then, just because a claims settling agent has to be mentioned, it is not compulsory the claim settling agent will be in the same town of the where the beneficiary is situated. It can be in a different town, it can be in a different country also. So the LC has to be very clear as to what is to be expected out of this settling agent information. Has it to be in the same place where the applicant is, or it can be in any other place or any other country also. Suppose coverage is effected on a warehouse to warehouse basis. It does not imply coverage is effective not later than the shipment date. Suppose shipment date is today, the insurance policy date is tomorrow, and it says warehouse to warehouse cover. There is no clue that cover was effective from today, because today being the shipment date. So the insurance policy has to give some indication that cover was really effective from today, the date of shipment, and not from tomorrow, the date of issuance of the insurance policy, irrespective of the fact that warehouse to warehouse cover is already there or not. Now, it is permitted to spread the insurable risk or insurance risk among the various insuring companies. Now, what do we mean by that? Multiple insurance company can issue multiple insurance policies for one particular risk. Multiple insurance company can issue multiple insurance policies for one particular merchandise, provided, or normally they will do if it is a very large shipment, provided each document indicates each insurer's cover. Each document indicates each insurer's cover, and then each insurer to bear their share of the liability jointly and severally. Each insurer has to bear their share of the liability jointly and severally without any preconditions. The insurance policy should not say if insurance company A pays, then I will also pay. They should pay their share of the liability, come what may, without any preconditions, and the document should indicate each insurance for how much each is paying. One is 30%, one is 40%, and the remaining 30 by another. And then it should show value of each document. The value of each cover when total should equal the at least the insured amount of it. So if you are looking for 110% of the invoice, then one should say 10% of the invoice, another should say 20% of the invoice, another should say 40% of the invoice, and all these insurance policies and all these insurers, their liabilities put together should meet the minimum requirement under the credit. The insurance policy should not evidence cover for goods not called for. Invoice should not evidence goods not called for. Insurance policy should not evidence cover for goods not called in, additional goods or whatever. It should appear to have been countersigned if the policy so demands. If the policy says this insurance policy or insurance certificate is not valid unless and until countersigned by the insured party or by the shipper or by any other party, then it has to be countersigned. If the policy so demands, it should be countersigned, or else there is no necessity for every box of signature to be completed for the document to be complete. It must be endorsed if it is issued to order of the shipper or to order of any other party. Then it must be endorsed. It must be endorsed in the fashion to assign the rights under the policy to a party named in the credit. If the LC calls for, the policy should be issued to the order of the applicant or to order of the issuing bank. And if it is issued to the order of the shipper, then shipper should endorse so that the right will get assigned to the issuing bank and the applicant, the party named in the credit, by the party to whose order claims are payable. If the claims are payable to the shipper will endorse so that the claims will be payable to the applicant or the issuing bank. It should not evidence that claims are payable to the order of the beneficiary. It should not say claims are payable to the order of beneficiary or a party other than issuing bank and applicant. The insurance policy should not say claims are payable to a party other than issuing bank and applicant unless and until it is suitably endorsed. It means if it says claims are payable to beneficiary, then beneficiary will have control over the insurance policy. To avoid that, it has to be suitably endorsed and submitted to the nominated bank so that the title will get transferred to the issuing bank. The insurance policy should identify the issuer who is issuing the insurance policy, or who is insuring, or who is undertaking the insurance risk, or who is the underwriter. It has to identify. The policy should mention the amount covered as well as the currency. It should be the currency of the credit or currency of the invoice. It should list down what are the risks covered and risks that are not covered. It should also mention who is the insured party and who has the right to claim under the policy, and whether if it is to order, then you need to be endorsed. So whether it is to order or state consent, that also should be mentioned. Claims are payable to whom? Is it to a particular party or payable to a order of a particular party, or it is just blank out to order? It should state the issue date, and it should have an effective date if the issue date is not to be the effective date. It can also state the exclusions and deductions. The exclusions is what risks are not covered. Deductions is the 5% franchise or excess that we have discussed earlier. There can be no expiry date for claims. There can be no expiry date for claims. The expiry date for presentation of claims. And then goods. What are the goods that are covered? It should be, need not be a mirror image, but should correspond to what is mentioned in the credit and the invoice. And it should also talk about where it is, what it's being covered, the port or the voyage. It should say shipment from A to B has been covered, because this is basically we are looking at marine transit insurance. It should say how many originals has been issued, and all such originals will have to be submitted. Mostly it will be 2 originals. And if there are any corrections, it has to be rectified. And the form of the document is, and the title of the document is of no significance. But if a certificate is called for, policy is acceptable. If a policy is called for, certificate is not acceptable, and cover is not acceptable. And broker's cover note are rarely accepted unless the credit explicitly says so. So this is a fast summary on the insurance document. Please keep coming back. We shall meet again on another video. Thanks for watching.